John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hello, my name is John Ulzheimer. I am a consumer credit expert with almost 30 years of experience in the credit industry. I have spent time at FICO, which is the company behind the FICO credit scoring system, and Equifax, which is one of the 3 credit reporting agencies in the United States. Today, I'm going to answer a question that I get quite a bit, which is about student loans. And the question specifically is, hey John, should I consolidate my student loans? So the answer to the question is going to be, as it is in many cases with respect to loans and how to treat them, is it depends. What people don't generally understand about student loans is that they are credit reported on a disbursement by disbursement basis. And so even though you took out student loans, paid for college, got a degree, now you write a check every month to the servicer, you actually probably have several loans appearing on your credit report, especially if you took out multiple disbursements during your college career. So if you took 5 disbursements, you're going to have 5 loans on your credit report. And so it's going to be reported as a loan by loan, disbursement by disbursement basis. So that's what we're dealing with respect to how student loans appear on a credit report. Consolidation is really an option that you do have. And so for example, if you are paying an interest rate of, X, and you can consolidate your student loans and essentially refinance them and put them all into one loan instead of multiple loans, and the cost of doing so yields interest rate Y, and Y is less than X, then obviously consolidating is a good idea because it's going to save you money every single month when you're making your payment, because you're paying less interest. You may be able to pay the loan off faster because you may be able to apply some of your disposable income from not paying a higher interest rate to the principal balance, and you may be able to get out of the loans quicker. Just be careful, because I know some student loans the interest is tax deductible, but if you refinance them, then there's a possibility that the interest may not be tax deductible. So the net effect of what you have done may not be as favorable as you may think. So you're going to want to check with your tax person for that particular one. So number one is you're definitely going to have fewer loans. That is not a bad deal. Even though you're only writing one check or making one payment every month, it's actually being applied to multiple different loans. Next, could be cheaper, which is always a double check. That's always great when you're paying less for the money that you've borrowed rather than paying more. But I think one thing that people don't think about when they're thinking about refinancing and consolidating their loans is, well, what's the effect on my credit? Is there a tangible score benefit to consolidating student loans? And the answer is that it's quite possible. So when you are making payments on your student loans every month, obviously it's going towards your multiple loans, it's bringing down your balance month over month. Student loans are installment loans, meaning that you have a fixed payment for a fixed period of time. It also means that they're not terribly influential to your credit scores. And so getting out of the debt may feel great, and it is great because you're not having to write checks every single month or make payments every month any longer. You don't have that debt hanging over your head. But you should not expect your credit scores to improve drastically, if any at all. And the reason is because when you took out the loans, they were not lowering your score in the first place. And so if you pay them off, you're not going to get some sort of a magical score boost because you weren't being negatively impacted in the first place. So from a scoring benefit, I would not expect much, if anything at all. What you will be doing, which actually is important in credit scoring systems, is you're going to be eliminating accounts with balances. And that's one of the aspects. If you looked at kind of the pie chart of what makes up your credit score, about 30% of the points associated with your score are going to be, actually, probably 30% is actually probably closer to that. So I apologize for my bad pie charts. So about 30% of the points in your score are going to be associated with debt-related metrics. And one of them, there's a lot of confusion about this. A lot of people think that this 30% is the balance to limit ratio on your credit cards. That's incorrect. That's certainly a part of this category, but it is not the category. This category also has several other metrics, and one of them is the number of accounts that you have with a balance. And so to the extent that you can consolidate your student loans And this applies for anything. If you consolidate credit card debt into an installment loan, you're going to be eliminating multiple accounts that have balances, and you're just going to yield one account with a balance instead of multiple accounts. That's great for your credit score. So really, you're going to be doing the same thing here if you're going to consolidate student loans, because you're going to be eliminating multiple accounts that have balances, because remember, they're reported on a disbursement by disbursement basis, and you're going to be left with essentially one loan instead of what's reported as multiple loans. And so you're going to have fewer accounts with balances, which is beneficial for your score. So these are some things that I want you to consider if you do have the opportunity to consolidate your student loans. Don't just think about, oh, well, is it going to be beneficial to my score? That's fine. That's kind of like a good byproduct of consolidating, but you're also going to want to make sure that it's cheaper, that you're saving money by doing so. You want to be understanding of your tax implications. By consolidating, you don't want to remove a tax benefit that you're enjoying and really not changing the interest rate enough so that it's really in your benefit to have done so. But to the extent that you can do it, which means that you're making enough money that you can qualify for a debt or a debt large enough to pay off student loans, what you're probably also going to do, and your parents are going to thank you for this, if this is a federal student loan, it is very, very likely that your parents are co-signers, because the majority of federally guaranteed student loans have a co-signer, and that's very likely going to be a relative of yours. When you consolidate and essentially refinance those, you're going to be removing your parent as a co-signer, which is going to be good for them because it's going to help their debt to income ratios, because they have less amount of debt and less obligations to make a monthly payment. And it also might be helpful for their scores because it's going to be eliminating the debt off of their credit reports as well. So think about those things. If you have any other questions, drop them in the comment section below. It was nice talking to you, and we'll talk again soon. Have a good day.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.